And welcome to this week's show.
All right. What a week. Holiday shortened week, but what a week it has been.
Yeah, I didn't realize till I woke up this morning that it was holiday. Had my head in the weeds this week. I forgot it was Easter.
Yeah, well, it's good for me. It gives me a rare day off. Off-ish, anyway.
Yeah. I wish the market was closed every Friday.
I think Good Friday should be a thing.
Every Friday.
Every Friday is good.
Every Friday is good.
So I started, I had because the market's closed today, I had some time to think more about the newsletter for the weekend. And I started looking at the conditions that exist now are very strange. And I did some research on when was the last time we've seen conditions that are like this. And I started to feel like I was sourcing my inner Ray Dalio. Because if you ever watch any of his stuff, he talks about what things that happen now have never happened before in his lifetime, but have happened a lot of times in history. And
right, yeah, it's interesting the way he always puts that, trying to put it in perspective, which is just a reminder that just because you're 70 years old or something like him, or 50-something like we are, like just because it hasn't happened since we were alive doesn't mean it hasn't happened a few times.
Right,
yeah.
Right. So I don't know if I'm going to be able to remember all 8 of these, but stocks down, bonds down, flight from U.S. equities, gold way up, inflation not necessarily a thing, but tariffs, I put that in there. Basically, I did this list of things that are really unusual that are happening now that are conflicting. Usually when the stocks are going down, investors are fleeing to the safety of U.S. Treasury bonds, and the opposite is happening now. And you add tariffs in there, and I went back and looked at it, 1974 and the panic of 1896 are like the only 2 examples where the majority of these 8 things that I'm going to list in the newsletter actually were happening at that time. And as you can imagine, both of them included a 50% or more decline in 1974 it was the S&P 500, in 1896 it was the Dow Jones Industrial Average. But huge turmoil around the world, and basically all that to say, is it possible that things just get sorted out and we keep on going higher from here? And that's certainly what you want to hear if you're a buy and hold investor. The history does not show that that's what is likely to happen over the next few years. So, we respond to the market. We don't predict it, but it certainly helps to have an understanding of what times in the past have looked like this.
Yeah, that's not the same as predicting. Predicting would be using it and then pre-deciding.
Yeah, that's
where a lot of people get lost as far as our kind of methodology. I think sometimes, many times, and I know you see it all the time, so you get kind of sick of it. But you guys can't time the market. We don't try to time the market. We respond. That means it has to have already happened. So you're not predicting it. We wait to see what happens. And if you see an obvious trend change, and when I say obvious, that means it's backed up by data, right? Multiple indicators, blah, blah, blah. Like all these things say the trend has changed. Well, that's about the best you can do. And you can't do that before the trend changes. So it's not timing. The other thing is there's no prediction involved, right? Predicting would be kind of what you're describing, where I go back and I look at all these historical events and say, okay, this is what I'm going to do before it ever happens.
Right.
This is what I'm going to do. Okay, well, that's predicting. And, it's gambling. But there's nothing wrong with looking back and going and see what the probabilities are. That's very different. Probable is not the same as predicting.
I mean, knowing your environment. That's all it is.
Yeah, knowing where your world. I mean, you have to do some research right now if you're going to have any idea like how to respond to this stuff. If you're just winging it, if you're just watching, one of the major cable networks or whatever you call it, the news networks. If that's how you're getting your financial news, you're going to be shook. It's not going to change. And that's actually what's happening to people right now. I mean, there's so many people that were so confident for the last decade or so that, have reached out to me and going, what the heck is going on?
Yep.
And I'm like, well, none of us know. Like, I don't have an answer to that question. If I did, I'd be in a lot better situation. Nobody knows. That's the problem, though. That's the chaos. That's the vulnerability right now, is the lack of
certainty.
Yeah.
I mean,
lack of certainty and lack of trust in the system,
Yeah.
whatever that means, right? Not to say that, anyway, it's just so much is going on at once, because if you took tariffs, for instance, if you took tariffs and you did them, 6 years ago, 4 years ago, things look different. It's doing that now with all these other things you just mentioned that just makes it a time that we haven't seen, not since we've been alive.
No.
Well, I mean, we were alive. We weren't very old in the 70s, but anyway. Yeah.
Well, the 70s is different too because, one of the things I forgot, but it's on the list of 8, is oil prices falling. So in the 70s, we had an oil spike, right? So that's not the same. So it's like history rhymes, it doesn't repeat.
Yeah.
But you get enough of these factors that it's similarities to what's happened before. It's not going to be exact.
Yeah, and you won't be able to predict based on it, but you definitely at least will know what kind of environment you're working in. I mean, the tariffs really. I mean, I haven't done a lot of research on this yet because I still take this with a grain of salt until it's kind of played out, because we haven't really done a lot of this stuff with the tariffs. Like, it's just kind of like.
It's a looming cloud.
Yeah. Well, let's say it's not a negotiation tactic. We really are going to carry them out. Then it's going to be really interesting to watch how this all happens, because once it actually gets instituted, that's where things really change. All these price hikes that happen and all these things happen. Okay, if you want to buy decorations for your house for July 4th,
they're all made in China.
You're not getting them, or you're going to pay a lot of money for them. So anyway, we have to wait and see. So I don't see any point in like really stressing out about it until the only stress is that because of the the hype of it, it's got investors going crazy. And so
one of the things that is interesting in the data this week, there was a lot of consumer spending in the past few weeks. A lot of it is on cars because people are, but at the same time, the other numbers, the economy is deteriorating for sure. But there's a big uptick in consumer spending because the theory, everybody's getting ahead of the tariffs.
Yeah. I'm considering doing the same thing for a couple things. I'm like, okay, well, would that increase this thing that much? I don't know. Like, you want to take a chance?
That's exactly right.
Yeah. So if you want to buy a car for your daughter right now that's in college, you're like,
you might better hurry up.
Do I wait till her senior year or just go ahead and get it now? Yeah.
All right. Well, we'll get into the micro, I guess, and then sort of the macro. So what happened this week, and then there was a couple big things that happened this week that actually matter as opposed to the normal things we talk about every week. And then we'll look at some of the big picture charts. We've put them up before. They're kind of updates, and then TSP Fund charts. So we had consumer inflation expectations on Monday. They rose from 3.1 to 3.6, which doesn't seem like it's that big a deal, but the forecast was 3.3. S&P's up 0.79% on Monday, but this is what it looks like year over year. So obviously March was a huge spike in what consumers expect inflation is going to be going forward. And that kind of goes to the front loading of buying cars and buying things. I mean, if you think that inflation is going to be much higher going forward, you're going to try to front load that stuff to the extent that you can. Tuesday, New York Manufacturing Index fell 8.1 after being down 20 last month, and the forecast was down 14.5. So not much of an improvement, but I mean a little better than forecast. The economy manufacturing is certainly rolling over. S&P is down 0.17% on Tuesday. On Wednesday, you get 30-year mortgage rate rises again. Had been falling a little bit, but rose again to 6.81% from 6.61 last week. New applications dropped 8.5%, but after they had risen 20% last week. So it's volatility in all the markets. S&P was down 2.24%. That was really on the Fed's remarks and interview at the Chicago Economic Board of Chicago, I think it's called, but we're going to get to that in a minute. Thursday, initial job claims are 215,000 versus 224,000 last week. So that's sort of a positive, right? There are fewer initial jobless claims, but continuing claims rose a little bit. And the S&P was up 0.13 on Thursday. And then Friday, the market is closed for Good Friday. So what actually mattered this week? So on Wednesday, the Fed chairman does this interview at the Chicago Economic Club, and so these are really the top five kind of takeaways. And the first piece is the most important one, really, for the market. But overreaching theme from Powell was that structural uncertainty, sticky inflation, and cautious policymaking. Right, the Fed's in a trick bag, but they're replacing the once dominant narrative of rapid normalization and economic clarity. From his perspective, things were starting to normalize, and then now all these new policy changes are making it very difficult for the Fed with their dual mandate. So the Fed says they are not in a hurry to rescue markets. That alone marks a critical regime shift for equity investors. One of the reasons, I'm not going to say the reason, but one of the big reasons the market was down big on Wednesday is because the Fed came out and basically said, no, there is no Fed put. We are not coming to the rescue of the markets if they fall. And that had a big impact on Wednesday. But the five big takeaways: tariff-driven inflation risks and supply chain disruption, right? Tariffs are no longer seen as a temporary blip. Powell acknowledges that inflation could rise persistently if they delayed and lead to delayed price increases. Global supply chain problems, a lot of the same kind of stuff we had during COVID. Diminishing hope for rate cuts in the near term. So this is really Powell going head-to-head with Trump, because Trump is all over him about cutting rates. And he says, while he doesn't explicitly rule out rate cuts, emphasized inflation remains above the target. High inflation and rising unemployment could make policy responses more complex. Reduction, balance sheet reduction. So quantitative tightening says will continue slowly. So they are continuing to restrict rather than quantitative easing. They're continuing this quantitative tightening. It's slowing the pace of QT, but it's not ending it. So slower quantitative tightening reduces the risk of a sharp liquidity shock, which is supportive of market functioning, but also suggests no rush to inject fresh liquidity. So he's saying that he's not coming to the rescue of the markets. U.S. fiscal path is unsustainable long term. For anybody that watched this, I was a little bit disappointed. He took a shot at Trump and Musk, really, by saying that the problem is not what the administration is trying to work on. They're looking at domestic spending, and domestic spending, he basically said, isn't the point. There's not enough in domestic spending that it has a dent in the debt. It's also security and Medicare. And so, and then he just left it at that. And he's like, so what they're doing is kind of a waste. It doesn't address the problem. Now, he didn't go on to try to solve the problem. He just said that what they're doing isn't helping. And I don't know who wants to take on the third rail of Social Security and Medicare. Anyway, they're in a very public fight right now, Trump and Powell. And then persistent policy uncertainty is hurting investment. Yeah, Powell underscored that uncertainty around tariffs, trade, and regulation is dampening business investment. Companies are hesitant to reshore, which is what Trump wants, or expand without clarity, right? I was actually amazed that last week the market was up the second or third biggest move in history on this announcement that the tariffs were going to pause for 90 days, because the pause creates more uncertainty. And to his fifth point, right? Uncertainty around tariffs, trade, and regulation is dampening business investment. Like, you can't, if you're a big company, that 90 days doesn't help you. It just creates more, because you don't know what's going to happen at the end of 90 days. So now you're just sitting back. There's nothing you can do until you get told what the actual policy is going to be. And so why that resulted in a huge, other than the fact that we were extremely oversold at the time, and that's why it didn't stick. That's why since then the market's rolled over. All right, this is a really interesting one. Malden Economics. So John Malden's been around forever, and this is an email that, or a piece of an email he put out the other day, and it kind of goes to what we've been talking about. So he's saying the gloves are off. The world's two largest economies are now in an open trade war. We're sitting squarely in the blast zone of what's unfolding, and there's no avoiding the consequences already hitting the tape. Right? On Tuesday, news broke that the U.S. government informed NVIDIA it would prohibit all future exports of the H2O chips to China unless the company secured a license, and there's no clear path to approval for the license. The immediate impact, a projected $5.5 billion charge, was a 6% drop in the price of NVIDIA after hours. And then the same night, Tesla halts plans to ship Cybercab and semi-parts from China. So the message from Washington is loud and clear, right? We may want countries to choose between us or China. And there's a lot of stuff going on around that, certainly between Mexico and Canada and the U.S. Retaliation is accelerating, and soon everyone will have to choose sides. Yes, the world is getting more polarized. So what happens if China bans all Apple and Tesla products? How do we invest when volatility is no longer a bug but a feature? That's really the big question of the email. How do investors invest when volatility is no longer a bug but a feature? And then for the week, NVIDIA was down 8.5%, and Tesla was down almost 4.5%. So it's going to be quite the ride going forward. All right. So from the technical analysis perspective, what can we kind of use to look at this stuff? This is so ratio charts are really helpful. This top chart is the ratio between consumer staples and the S&P 500. So consumer staples are things that people need as opposed to what they want. So companies like Pepsi and Costco and other companies that make things that we have to have even if we're in recession. So if the market's going up, it's because growth companies are doing well. Defensive companies like staples do well when the market's going down. So if you do the ratio, when the XLP is going up relative to the S&P 500, the economy is weakening and the S&P 500 is going down. So if you look at all these times back here, when the ratio goes up, this is the S&P 500 down here. The S&P 500 is going down, right? When the ratio goes up, the S&P 500 goes down. And it tends to lead. So like back here, it peaked and then came down, and that's what led, because people were getting out of consumer staples, going into tech, which was the big run-up that we had in the S&P 500 going into the top in January 2022, right? And then 23, the stock market is falling. People are buying consumer staples rather than tech. And so if this was the swing low, right, which was the peak in 2022. We are back to that level right now. If we get above that line and keep on going, the market is coming down. Okay, so if people continue to have concerns about the economy going forward and they're worried about tech, they buy staples, they sell tech, and the S&P 500 goes down. So it's a pretty good line to watch. If you've ever heard of when the spreads blow out, is how you usually hear it in the mainstream media. So the index option adjusted spread, it's just the difference between high yield bonds and like treasury bonds. So like fixed treasury bonds, risk-free bonds. And the bottom one again is the S&P 500, is this one. So this is the spread, and this is the S&P 500. When the spread starts blowing out, it usually happens before the top in the S&P. Okay, so going into the tech bubble, spreads had already started going up, and then the market rolled over. 2007, same kind of thing. Spreads start blowing out, and then the market rolls over. Okay, same thing in 2011. Spreads go up, market goes down. Where we are right now, we were in this very clear downtrend in spreads, right, as the market is going up. And we broke that trend line, and now the market's coming down. So as bondholders demand a higher yield for corporate debt and treasuries come down because the economy is weakening, this line goes up and the market comes down. Employment population ratio. So all this is, we showed this chart a few months ago, but all it is the people that are employed divided by the number of employable people. So it's a chart of basically the level of employment in the U.S. It's not the actual employment number. It's relative to the amount of people that could be employed. And every time it starts to roll over, the green sections are recession. It runs up, rolls over, we have a recession. I mean, it happens every single time. And it never, like, rolls over and then turns back around and goes up. It just doesn't work that way. And so I think we showed it back here when it started turning, or maybe back here when it started to flatten out with the expectation that it was going to come down. So it kind of went sideways for a little bit, and now it's clearly, more clearly coming down. The idea is it plummets, and we get one of these green recession bars. And then the 10-year minus the 2-year treasuries. This is a kind of a classic one that everybody looks at. They always say if it goes negative, if it gets below the red line, that's like an indication that recession is coming. That's when everybody starts worrying about recession. But it's really when it gets negative and then turns back up that you have to really start worrying about it. And that 0.33 line is when things get real serious, when it's coming back up on the other side. So every time we get above 0.33 is really when recession is just about ready to take off. And we are there right now. Okay. So this is basically just to say all the things, the history, the macroeconomics, and the fundamentals, at least from the chart perspective of the big picture, nothing looks good. Does that mean we can't have a blow-off top from here? Nope, it's possible. But nothing looks good. So this is the S&P 500. It's actually our C fund. It's not the S&P 500. This is the actual chart of the C fund. Each tick is 1 week of price movement, and this is the 20-week moving average line and the relative strength indicator. So once price got below that 20-week moving average line, which it hadn't been below there since the breakout in late 2023. So we had closed every week above that line until it was February, a week in February. We closed below that line for the first time in quite a while. And relative strength got below 50. So that was certainly an indication that something had changed. And ever since then, the market's basically been in a free fall. This last week's candle was all from Wednesday, right? From that big update that we had on Wednesday. And then this week, the market's rolling over again. We don't have a lower low yet, so it's possible that somewhere in here we get some stability and start moving higher. It's a possibility until we get below this lower low. It just doesn't look good. S Fund is kind of a disaster. Same week we got below the S Fund's 20-week moving average line, and it just collapsed to the downside. You could say, well, we got overextended to the downside on relative strength, and so we're due for an uptick, right? Because every time we get down here in relative strength, we have a rally. Yeah, we're definitely due for a rally. But the trend is most certainly down. Okay, iFund. So let's just talk about this for a minute. The Fed we've been tightening, right? We've been increasing. We increased rates for a long time, and then we paused, right? And we haven't reduced rates yet. But Europe has decreased their rates 7 times since last June. So their economy is getting worse. Their economy is worse than the United States. But they're lowering interest rates. We are not lowering interest rates. And you add on to the tariffs, there's a flight out of U.S. and into Europe and Asia. And that's why the iFund is holding up better It's not collapsing. Obviously, this big spike down, right? It's a lot of volatility still in the I fund, but it's not collapsing yet as bad as the U.S. is. So if I want to invest in the I fund, just because it's holding up relatively better than the U.S. doesn't mean I'm going to go 100% I fund. If we can get this is the 2007 top, right? We haven't gotten above it since 2007. If we can get above it, then it's clear skies. And then this becomes support instead of resistance. But right now, it's still resistance until we can get above it. And so in the short term, yeah, is the I fund better than the C and the S funds? Yeah, absolutely. But there's a lot of risk there. This is the EFA, so it's not our actual I fund. This is the Europe Asia Far East Index. It's the old I fund. The new I fund looks like this. Still clearly holding up better than the C and the S funds, but we had a huge down week 2 weeks ago, a rally last week, and then a big pop this week. And we got above that 20-week moving average line. And relative strength is certainly holding up much better than the C or the S funds. So looking at this chart, would you invest in the I fund? You have a lower high and a lower low. Until we get at least back above this high, from the chart perspective, it's not, yes, it's holding up better than the C and the S funds, but it's certainly risky. And then the F fund is another one of those things that goes along with what is not supposed to be happening. You got a big move off this bottom in January, a 4 or 5 week consolidation here, and a huge breakout to the upside. Right? In any other market condition, the F fund should have kept going, which would have gone along with a flight to safety because the stocks are going down. It's a flight to safety to U.S. Treasuries, but that's not what happened. The next week, we got the flight out of U.S. Treasuries. So from 1 week to the other, that swing is pretty unbelievable. So I don't know. In this kind of environment, the G fund is not a bad way to go because it always goes up and to the right. Questions?
I got a lot of questions, but nobody here's got any answers. So
No.
Yeah, it's I don't know. I hate to say it's a bad time to be an investor because it's just because our options are limited, and mostly because they're really limited in the TSP.
Yep.
Right? I mean, now is probably a time when if you are a very educated investor and your limitations are the TSP, for your retirement account, this is a time you might want to start looking at the mutual fund window. Mm-hmm. Because at least there are things within that 5,000 mutual funds that could potentially be moving up, right? Mm-hmm. And we're not going to filter through those 5,000 for you and do that. But if you're an educated investor, you know what you're doing. That does open up other opportunities, right? And so that's not something that a lot of people are talking about right now, but I think it is, it's a potential opportunity. Again, if you're not an educated investor, you don't know what you're doing, that's probably not the place for you. If you're going to go in there and speculate, and gamble and try to, that's probably not the best idea. But
no, but the overriding thing, I hope, if people are watching the show, if you're a buy and hold CNS person, if you haven't figured it out by now, this is it's simply not the environment that's conducive to that investment philosophy. That's all. It's not like I'm right, you're wrong. It has nothing to do with that. The environment that we're in is extremely volatile. It is not conducive to a buy and hold strategy.
Yeah, and there's just no reason to absorb all that volatility when we have the G fund.
Yeah.
And if you have any questions about, while all my buddies are saying you gotta ride it out, are you going to lock in your losses, are you going to do all these things, please go to our website, look at a few of our blog articles. They explain these topics and why they don't work necessarily the same in the TSP funds as they do in regular brokerage accounts or IRAs and things. Not particularly IRAs, but the
401k.
So here's the thing: just get educated. Don't trust your buddy at the water cooler or the coffee shop or whatever. Go out and if you don't believe us, read our blog article and then go Google it, right? Go ask ChatGPT, ask somebody else. But there is no reason to ride this out, particularly if we have like a long term. That's what we're all sitting around kind of waiting to see, right? Is this another quick kind of V bottom? We're back in the race. Things are back to normal. Okay, and all this will be forgotten. But if this is like, a few other times we've seen in our career, the last 30 years, we could be in for a ride for a while.
The Fed said, whether or not they follow through with it or not, they said they are not coming to the rescue.
Right, that's that's it. So last time the reason we had that quick change was they came in and rescued it.
Yeah, 2008 and and COVID.
Yeah.
Yeah.
So if they're not going to do that and they hold to it, we're in for a ride, and it may not be a good ride. All right, guys, if you have any questions, shoot them to in the comment section wherever you found the video. And if you don't have a comment section, you can always email our support team, support@growingbytsp.com, and they'll get it over to us. Hope you guys have a great week. If you celebrate Easter, I think it's Happy Easter this weekend. Easter. Yeah, I got to get caught up and go talk to the bunny. Right,
apparently we have eggs, so that's a good thing.
Yeah, we're back to having eggs. All right, guys, have a good time.